Here are the top 5 economic indicators that a trader must watch. Number 1, interest rates. So a central bank will set interest rates based on the performance of an economy. If we are in a time of economic boom, central banks will be raising rates. So let's take an example and put it into a nutshell. The FOMC. The US economy is performing well. They start raising interest rates, okay, because we're seeing a decent economy. Inflation's high as well, so we want to keep inflation in check. Now, when that happens, what we tend to see is strength in that respective currency, strength in a dollar, because we are raising the yield also that a foreign investor can get. It will attract more foreign investment if a central bank is raising rates, okay? In terms of the relating indices, stocks, right? Stocks typically in higher interest rate environments, their performance tends to be capped. You know, it can invite some selling to stocks because remember as well, we're raising costs for consumers. We're raising costs also for businesses. Businesses have, you know, loans that they've used to boost out business infrastructure, so on and so forth. So in times of high interest rate environments, strength in the respective currency, weakness in the respective indice, the upside pretends to be potentially capped for indices, okay? And obviously on the flip side, if we've got economic downturns, central banks are cutting rates, right? We will see weakness in the respective currency, say for example in the dollar, and we may see strength in stocks, okay, if we've got a low interest rate environment, because typically speaking as well, what we could see is the central bank also, with regards to the rate cuts as well, pumping money into the economy, okay, what's known as QE. And with all this money being pumped into the markets, okay, it means cheap borrowing. Okay, people will take that money and then go and spend it on this business, or the business may take that cash and boost out their infrastructure. Okay, so that's seen as a benefit for stocks. So in a nutshell, typically high interest rate environment, strength for the currency, weakness in stocks. Low interest rate environment, weakness for the currency, strength for stocks. The second indicator is GDP. Now, this is gross domestic product. Effectively, we want to understand how an economy is performing. Is it growing or is it contracting within a certain period? You can get GDP readings on a monthly level, quarter on quarter, year on year, and it's to understand for that period, how much growth have we seen for the respective economy, or are we observing a contraction? Okay, if we're getting a contraction and we get back-to-back negative readings of GDP for an economy, that is potentially a technical recession. When we're getting back-to-back consecutive negative GDP readings, that is a contraction. Now, of course, if it's obviously we're getting decent growth, outperforming market expectations, we're going to see flows into that respective currency. This can also benefit stocks as well. If an economy is performing well, see, it's going to attract more money coming in. Okay, we've got more money going about, people spending, we're in great times. So typically it should be a positive for both stocks and a positive for the currency as well. 3, the labor market. So there's various labor market indicators, but you're typically looking at jobs being added. For example, in NFP, employment change. You're looking at the unemployment rate. You understand the wages. This is all important, and it plays a key role in shaping up how an asset moves. Because if we've got a healthy labor market, for example, right, decent amount of jobs are being added to the economy, the unemployment rate is low, wages, what people are getting paid, is high. We got a strong labor force. What do you think that strong labor force is going to be doing? They're going to be out spending money. We're going to be buying these goods. We're going to be using this service. We're going to be investing money into stocks. The economy is booming. Okay, so that's inflationary. With that as well, with the positive labor market, obviously the economy is growing, the economy is expanding. You know, effectively prices of goods and services are going to be rising as well. And that goes back into what I was saying as well about the central bank. If we've got a booming economy, if we've got a booming labor market, central banks will be raising rates. So that would be positive for the respective currency as well, okay? Because we've got a healthy labor market outspending. So you need to keep an eye on all those indicators around the labor market. 4, retail sales. Retail sales give us the performance of how retailers are doing. And why is that even important? It's important because if retailers are doing well, what does that suggest? It suggests consumers are out spending money, right? We goes back to all those previous points that we mentioned with interest rates. It goes back to labor market. You know, if we've got all these things are moving in the right direction, people are out spending money, spending. So the retailers, their performance is going to be strong. We're going to see stronger retail sales. And with stronger retail sales, this is great for stock. This is great for the respective currency as well. We're in that period of economic boom, but obviously if we're getting worsening retail sales start contracting consecutively, you know, maybe we're seeing low growth, maybe we're seeing a poor labor market. You put all these indicators together and you form a view on the economy, but that would be obviously a negative as well for that respective currency, a negative potentially for stocks as well. If people are not spending money, of course, then the stocks are not benefiting. We're going to start getting job cuts, and you start putting all the pieces to the puzzle together. of all these economic indicators, and you form a view of should these indices be trending to the upside, should this currency be trending to the downside versus another. You start to do, for example, GBP versus the dollar, euro versus the dollar, see which economy is performing better. Okay, and that's, you're following the flow of money, because the way in which what I'm talking about here is what a foreign investor, it's what the big boys, are talking about. This is what the big boys are analyzing. They're not just saying,
oh, look at this technical head and shoulders on the chart.
They're understanding the underlying macros for where they should put their money. They don't care about, oh, there's a head and shoulders here, let me invest 100 million into the United Kingdom. No. They're understanding, how healthy is the labor market, how healthy is growth, how healthy is consumer spending, all of this stuff. And then that will help them form a view of whether they should invest in that economy. Follow the flow of money. Don't follow stupid technical patterns. 5, PMIs. Now, PMIs come in the shape or form of manufacturing and services. Now, this is where it comes down to you doing a little bit of research, right? And understanding, is this economy a decent manufacturer? For example, the Eurozone. The Eurozone relies on manufacturing because, I'm sure you're aware, we've got a load of European cars. We've got German cars, Mercedes, Volkswagen. We've got Italian cars, Ferrari, Fiat, Lambos. We've got French cars, Citroens, so on and so forth. So they are a decent manufacturer. They produce cars. So we want to understand how healthy is the manufacturing in the Eurozone, because that's going to be playing a part in whether we're seeing growth in the Eurozone, in the economy as a whole, or are we not? So we want to see the performance of those PMIs. And with PMIs as well, when you're looking at manufacturing PMIs, the gauge is you look at it, and if the number is above 50, that's growth territory. The sector is expanding, and that's positive for growth for the Eurozone. If it's below 50, that means it's contracting. That's a negative number, okay? And you also, obviously, at the end of the day, we want to see how is it performing relative to market expectations? How is it performing relative to previous? And then you've got services. The UK relies massively on services. That makes up, for the UK specifically, that makes up 70% of the UK's GDP. So we want to understand, is services performing well? Okay, and as I said, it comes down to doing a bit of research and finding out, is that relating economy heavily reliant on manufacturing? Is it heavily reliant on services? For example, in China, they're also a massive manufacturer. So understand, and it comes down again to putting the pieces to the puzzle, forming an overall view of all these key economic indicators and making an actionable, tradable decision on those charts. So it doesn't come down to just looking at one economic indicator and being like, yep, I'm going to buy the pound versus dollar, or yep, I'm going to sell euro dollar. No, it comes down to forming a macro view. And what I've just said can be simplified super, super easy, right? You're just analyzing those key economic data points and then putting them hand in hand with what you see there potentially on the charts, and then making an informed view. It doesn't have to be that overcomplicated by any means. So those are the 5 key economic indicators that you must know as a trader.